All right, let's talk about the 2026 market. It's a really weird landscape right now, isn't it? You've got some stocks hitting record highs while others are in serious trouble. It's confusing. So, over the next few minutes, we're going to cut through all that noise and give you a clear framework for how to think about it all. Let's dive in. To really get a handle on what's happening now, we kind of have to look back at 2025. I mean, it was a year jam-packed with geopolitical drama and really shaky economic data. By all accounts, the market should have taken a hit. But here's the crazy part. It didn't just survive. It actually thrived, climbing a wall of worry, as they say, and rewarding the investors who didn't panic. And that brings us right here to 2026. The big question on everyone's mind is, how on earth do you invest in this? With all this volatility, how do you even begin to build a smart plan for a future that feels so unpredictable? Well, that's exactly what we're here to unpack. Okay, before we can build any kind of plan, we have to be real about the challenges we're up against. Analysts have a name for it. They're calling it the wall of worry. And believe me, it is a pretty tall wall. So what exactly is this wall made of? Well, according to JP Morgan's clients, the number one thing is geopolitical risk. No surprise there. Then you've got the sticky inflation that just won't quit. And on top of all that, you have a global recovery that is just all over the place. Some economies are in a full-on sprint, while others are barely jogging. It creates a ton of uncertainty. So how do you even begin to invest in a world that's doing two completely different things at the same time? Well, there's a concept for this, and it explains everything perfectly. We're living in what's called a K-shaped world. A K-shaped market is, believe it or not, exactly what it sounds like. Just picture the letter K. You've got one arm shooting up and one arm trailing down. That's our economy right now. Some parts are absolutely booming, just rocketing upwards, while other parts are stagnating or even falling behind. It's a story of two completely different paths. And this isn't just some abstract theory. The numbers are staggering. On that upward arm of the K, you've got the 10 biggest stocks, which now make up a mind-blowing 40% of the entire large-cap index. But on the other side, that downward arm, a shocking 40% of companies in the small-cap index aren't even profitable right now. The gap between the winners and the losers is just massive. So once you get your head around this K-shaped world, it totally changes the questions you should be asking. So let's just dive right in and tackle the big ones that JP Morgan's analysts are hearing over and over again from investors right now. All right, first up, the one everyone's whispering about, gold. I mean, after the incredible run it's had, you gotta wonder, right? Is this just classic FOMO kicking in? Do we already miss the boat on this one? Well, the short answer is not necessarily. JP Morgan analysts are actually still forecasting a potential 30% upside from here by the end of 2026. The reason? It's pretty simple, actually. The big players, the central banks, they're still buying it up as a reserve. And for regular investors, with so much uncertainty floating around, gold is still that go-to safe harbor. Okay, let's move on to the next big question. For what felt like a decade, the playbook was simple: buy U.S. tech and you're good. But then 2025 happened, and a lot of those big names actually lagged behind the rest of the world. So where else can you even look for opportunities? Well, analysts have their eyes on a few spots. Sector-wise, think healthcare and financials. They haven't been bid up to insane valuations, and their earnings look pretty solid. And if you're looking geographically, places like India, South Korea, and Taiwan are getting a lot of attention. They have their own strong growth stories, but they're also deeply plugged into that global tech supply chain. And we have to ask this one. What about China? After a really strong 2025, is this rally for real? Is it finally time to jump back in? The answer here is, it's complicated. The big takeaway from analysts is, don't just buy China. You have to be surgical. They're targeting very specific pockets of opportunity. We're talking innovative sectors like AI, companies that are essential to China's big push for tech self-sufficiency, and those solid, high-quality firms that pay out reliable dividends. It's about using a scalpel, not a sledgehammer. Okay, so knowing what to look for is one thing, but in a market like this one, how you invest can be just as important. So let's look at a couple of tools that are really built for this kind of volatile environment. First up, there's something called an aggressive hybrid fund. Now, don't let the name fool you. This isn't for someone who wants zero risk. It's for what you might call a conservative equity investor. Basically, someone who wants the growth of the stock market but could really do without all the gut-wrenching drops.
So how does it do that? Well, the secret is in the mix. That big chunk of stocks, the equity part, that's your growth engine. But that smaller chunk of debt, the bonds, think of that as your portfolio's shock absorber. When the stock market goes haywire, that bond portion is designed to stay much more stable, cushioning the overall blow.
Okay, now for something a little more advanced, the inverse ETF. The idea itself is actually pretty straightforward. It's a fund that's designed to go up when the market goes down. It's basically a way for investors to hedge their bets or even profit from a downturn without getting into the complexities of traditional short selling.
But, and this is a huge but, you have to be incredibly careful here. These things are a double-edged sword. They are built for super short-term trades. We're talking days, not weeks. If you hold them for too long, weird compounding effects can kick in and you can actually lose money, even if you were right about the market's direction. Seriously, this is not a set it and forget it kind of tool.
All right, last tool, it's a technical indicator called the average true range, or ATR. And I know, that sounds complicated, but I promise its job is super simple. It just measures how much a stock tends to move on an average day and puts an actual dollar amount on it. So instead of just saying a stock is volatile, ATR gives you a number. Let's take a real-world example. A high flyer like NVIDIA might have an ATR that's over 6% of its stock price. That means on an average day, it's moving that much. Now, compare that to a steady blue-chip stock like Johnson & Johnson. Its ATR is less than 2%. See? That one number tells you so much more about the kind of ride you're signing up for.
Okay, we've talked about the wall of worry, this crazy K-shaped market, we've answered some big questions, and we've looked at some new tools. So, what do we do with all this? Let's boil it all down into a clear, actionable strategy for 2026. So here it is, your 4-step framework. First, acknowledge the risks. Don't pretend that wall of worry isn't there. Be realistic. Second, understand the K-shaped reality. Not everything is going to move together anymore. Third, diversify intelligently. Go look for value where everyone else isn't looking. And finally, fourth, if you're going to use these modern tools, you absolutely have to do your homework and understand the risks involved.
And that leaves us with one final question to think about. In a world that is changing this fast, with new challenges and new opportunities popping up all the time, maybe, just maybe, the riskiest thing you can do is stick to the old playbook.